All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is August 20th, 2026. Our top story this morning, stocks are lower after Walmart reported earnings. And a rare case of bad news is bad news. All right. Typically, bad news is good news because my Fed and my rate cuts and all that other stuff. No, the market is actually reacting directionally in accordance with the news this morning. Walmart just reported their earnings at 7 a.m. Eastern time, and they posted their worst comps in 6 years. And I would add that worst comp in 6 years, that's comparable to the peak of the lockdowns in 2020 when nobody was allowed to spend any money because if you went everywhere, if you left your house, people would freak out at you. So here we are 6 years later, and Walmart has had a really good run for the last couple of years. They made a very successful pivot into grocery. They gained a lot of market share. They've posted some tremendous growth because of that, much to the detriment of names like Target and Kroger. And it looks like that may have run its course now. And inflation is starting to take its toll. And where have you been for the last 6 years? Inflation is once again taking its toll on people after the big hike in gas prices we saw earlier this year with the outbreak of the war in Iran. It's starting to weigh on Walmart's numbers. And the market is not liking that at all. All three indexes are in the red this morning. Now, one thing did jump out at me in Walmart's report is they're citing weakness in pharmacy that made those comps particularly bad. Apparently, there was federal drug price negotiation that lowered drug prices in the quarter. Walmart cited that specifically as bringing their comps sharply lower. But other than that, generally speaking, we're looking at weakness in the consumer. We are a consumer-driven economy. It's like 3/4 of GDP in this country. And so if the consumer is not doing well, then it doesn't matter how much round-trip, self-financed, circular, whatever is going on over in AI and data centers, you're going to go into a recession. So Mark's starting to worry about that. And the market is also worried about the Bessent pump from yesterday. It's starting to fade already. That's interesting. Now, yesterday, we talked about this on the show. Secretary Bessent over at the Treasury announced that the Treasury Department was going to double the size of their Treasury buybacks. That's where the government issues more short-term Treasury bills, and they take the proceeds of that and they buy old long-term Treasury bonds. Now, while that is not money printing, it is not quantitative easing, it's not even true yield curve control, it is taking liquidity from Peter and giving liquidity to Paul, and it is helping to artificially lower interest rates on the long end and thus mortgage rates, business loans, credit cards, everything. That was announced yesterday. We saw stocks rip on that news. We saw the yen strengthen on that news. We saw Bitcoin absolutely ripped. Interest rates dropped substantially. That is all starting to reverse this morning, giving back about half of that. We've got yields are higher by about half of what they lost yesterday on the long end of the yield curve. We've got the yen is weakening again against the dollar by about half of what it gained yesterday. So it really looks like what Bessent is doing is temporary, or dare I say transitory, to use that word. Look, we've got this article in Bloomberg to this effect this morning. At the end of the day, Bessent is very powerful at the U.S. Treasury, kind of like the Fed. And, you don't want to be fighting the Fed or fighting the Treasury. But at the same time, what they're doing is a Band-Aid solution, and they're not fixing the underlying problems. And much like every time they intervene in the yen markets, you get these big step changes down, but then they didn't fix anything, so it just goes back to rising again. And it looks like the same thing could be true of the bond market. And case in point, not fixing your underlying fiscal problems. The national debt has reached $40 trillion. Congratulations, guys. We did it. 40 trillion. And I remember when I was a kid, one of my first memories in presidential politics was Ross Perot talking about how obscene it was that the national debt had reached $5 trillion. Can't finish. Yeah, with his five. We're doing $5 trillion in 2 years now. And that was the total of the debt back then. Now we're at 40 trillion. We went from 30 to 40 in what, like 4 or 5 years. When did we talk about breaking 30 trillion? I don't think it was that long ago. That was like 2022, wasn't it? What the heck are we doing? But, don't worry, because the Keynesians tell me we can do it forever. Like, let's make it 80 trillion by 2033 while we're at it. Why not? What's the worst thing that could happen? The Fed will just monetize it and everything's going to be great, right? Isn't that how that works? Anyways, all right. So speaking of the Bessent pump fading and reversing, one thing that is not fading and reversing is the run in Bitcoin. Now, it started yesterday with Bessent and his announcement of the Treasury buyback doubling, and Bitcoin just started to rip, and it never stopped. Bitcoin hit $72,000 this morning, up over $8,000 from where it was yesterday before Bessent's announcement. Now, the Bessent pump is what set that in motion, but it's not the only thing that was going on. We've also had some favorable rulings by the SEC about how Bitcoin is treated in securities laws. We had President Trump came out yesterday with some kind of announcement suggesting he's going to have people look into the possibility of the government somehow acquiring more Bitcoin in a manner that is budget neutral. How do you buy more Bitcoin without increasing the budget? I don't know. When you figure that out, let me know, and I'd love to do that myself. But so we had the government pumping Bitcoin yesterday, and then that triggered a short squeeze. And that's why it ran so much. You just had a lot of people with big levered bets to the downside that went against them yesterday. Mr. Margin called them up. They had to cover. That buying added to the increase that was already set in motion by some of those government announcements. So Bitcoin is ripping here. We'll see if this rise has any legs or if the selling just resumes once all the shorts have covered. We've got the United States and Canada are set to cut tariffs on steel, aluminum, and autos, because you can totally trust any headline about trade deals or peace negotiations these days, right? We've got China has sentenced the CEO of Evergrande to life in prison. Hui Ka-yan, the founder and CEO of Evergrande, the biggest accounting fraud in Chinese history, I think, or at least to date, he's going away and he will never see the light of day again. Now, that's interesting. I'm not one to champion the Chinese justice system, all right? I criticize the CCP to no end, and deservedly so. That being said, I look at how white-collar crime is being treated in China right now, and then I look at how white-collar crime is being treated in America, and what a difference. Hui Ka-yan is going away for life, along with dozens of other executives at that company. Here in the States, when there's a high-profile fraud, you get token prosecutions of 1, 2, maybe 3 guys. And then years later, they get presidential pardons, and they're out, and they're off to go do more fraud. Can't help but notice the Chinese are doing this one better. All right? I don't say that often, but I got to call it like I see it. And we've got to stop treating white-collar crime, which is rampant in the United States. We have got to stop treating it with the kid gloves, because white-collar crime begets blue-collar crime. People need to realize this. When a guy like this Mark Walters dirtbag at the insurance companies and the Lakers and the Dodgers and everything we're learning about him, all right, when thousands of people lose their investments, life insurances, 401ks, pensions, whatever, when thousands of people are robbed, that creates this scenario where hundreds of people start robbing liquor stores or drunk driving or get addicted to drugs or prescription painkillers and all the other crime that comes along with that, all because some billionaire dirtbag wanted to buy the freaking Lakers. And when they actually get prosecuted, what's going on right now with this guy Walters is he's trying to buy his way out of prosecution. That's why he's sold the Lakers and why he's selling his football club and everything else he's doing. He's trying to undo what he got caught doing, hoping he won't go to jail. And he's probably going to get away with it. Maybe we need to do things differently the way we prosecute white-collar crime. I just throw them out there. You guys do what you want with it. We've got big increases in defense spending coming from Taiwan. Grain shipments in the Black Sea from Russia and Ukraine both have ground to a virtual halt. That is driving food prices higher. And there's one thing you got to watch with those grain prices. We'll talk about that as well. And last but not least, we got to talk about Jefferies Credit Partners. They are looking to raise 1 billion euros for a private credit secondary fund. And if you don't know what a secondary fund is, that's when they're like, okay, we've got all this private credit in a fund. It's not worth what we say it's worth, and we can't sell it. So what we're going to do is raise money from other investors for a new fund, and then we're going to put that crap from the old fund into the new fund to use the proceeds to pay off the old investors. And if that sounds like a Ponzi scheme, that's just because that's exactly what a Ponzi scheme is. Yeah, that's what Jefferies is doing. But you know what? If you're thinking of investing, or if your pension fund, or the mutual fund that you're invested in is thinking of investing in this Jefferies secondary, you need only look at Jefferies' recent track record and say, yeah, this is a winner, a number one, this one. And we'll talk about some of the problems that Jefferies and their risk management people have run into. So, by the way, guys, if any of you are looking for a career change, I'm pretty sure the risk management folks at Jefferies are going to be looking to do some hiring in the weeks and months ahead. Call me crazy for that one. But first, hey, why don't we shrink my big melon of a head? Let's see what's going on in the world of finance today. Don't forget that like button, subscribe button, all that other good stuff for the algo, because it really helps out the channel. And hey, right now the S&P 500 is down by 30 points, 0.38%. You will notice on this chart right here, 700, that was Walmart earnings, and you can see the market started to roll over as soon as those Walmart earnings came out. Caught a little bit of a bump about 15 minutes ago here, but now heading lower again. The Dow, same thing, down 404 points, or 0.75% lower, almost all of that coming on the heels of Walmart's earnings at 7 o'clock. That is Eastern time. And the NASDAQ is off by 168 points, 0.57% lower. Again, there's your Walmart earnings taking the market lower. Even the Kospi this morning. We got to talk about this one because the volatility is back in South Korea. We've now had 2 consecutive days of 5% or more moves in the index in South Korea. Yesterday, it was down by 5, almost 6%. And then last night, it was up by 5, almost 6%. So the volatility is back. We had buku volatility over in South Korea leading up to that big yen intervention, which caused the best day in history for the South Korean market. Then we had about 2 weeks of relative calm that was purchased by Secretary Bessent intervening in the yen market. Boy, Bessent is quite the interventionist these days, isn't he? I mean, Yellen did a lot of this stuff. Bessent criticized her for doing it, and now he's doing it even more. Anyways, Bessent then got involved in the bond market yesterday, and the volatility is back in South Korea. The U.S. dollar, meanwhile, lowered by 4 basis points this morning, 98.75. That's off by 4 basis points. Not a lot to look at there, but it is worth pointing out the USD JPY chart. This is the yen. Here was yesterday, and Bessent intervening in the bond market yesterday. That was that red candle here. You'll notice that we are now gaining back about half of what we lost yesterday. This is another reason why I'm saying what Bessent did yesterday appears to only be temporary. We'll also see that when we look at the bond market in a second. And of course, this big move here, that's when the Japanese and Bessent both got involved and intervened in the yen market at the beginning of this month. Again, a very interventionist U.S. Treasury these days. Looking over at the bond market, we have got yields are back up on the long end, taking back about half of what they lost yesterday. Just a reminder, guys, yields rising, that's bond prices falling, and yields falling as bond prices rising. Yesterday, we had a lot of bond buying after Bessent made that announcement about the Treasury buybacks. We saw something like 9 or 10 basis point move lower in the 10-year yield. And once again, we're getting half of that back this morning. 30-year yield, 5.242. That is higher by almost 5 basis points. We've got the same move in the 10-year, back above 4.7, 4.701. That's higher by almost 5 points. Now, we were as high as 4.74 yesterday, and we went as low as 4.65 this morning. Back about half of that amount, back at 4.7. So again, what Bessent did, it certainly moved heaven and earth yesterday, at least temporarily. And well, now it's going the other way. It's just a temporary measure. The 2-year yield, 4.192. That is higher by a point and change. And the 1 month is lower at 3.682. Looking over at the commodities board, gold had a ripping day yesterday. And again, we're giving back about half of that. Gold rose over $100 yesterday. Here we are. Spot gold is down $48 or 1.07% at $44.74. We've got spot silver holding most of its gains from yesterday. Silver ripped by about $3 yesterday. this morning, down about 28 cents or 0.43% lower at 66.73. I like the shiny. We've got coppers down by 1% in change. Platinum is higher by about 1/3%. Palladium is unchanged this morning. And crude oil is higher by about $2.20 here, 2.6% higher. 86.58 for October WTI. No big headlines out of the Middle East this morning, other than the fact that President Trump has doubled down on economic warfare. Basically surround them and wait them out. That is now the strategy with Iran. They're going to leave the blockade in place. They're going to crank down on the sanctions and just wait for bad things to happen because money. And that is something of a walking back the military strategy, but, less shooting, probably better. Looking over at what's going on in Bitcoin, and again, just a ripping move in Bitcoin here, just below 72,000 this morning, $71,945 as priced on Coinbase. That's up $2,600 this morning after rising more than 6,000 yesterday on that combination of the Bessent pump and some favorable activity in Washington. The level to watch here, guys, I have a line drawn about 74,400. I've heard some folks in the media call out 75,000 as the resistance level. This red line is the low that was hit following the tariff panic of Liberation Day. And that is now the resistance that I'm eyeballing here. Let's talk a little bit about what happened yesterday. Crypto surge triggers $2.7 billion of short liquidations. We had a short squeeze. The crypto market suddenly sprang back to life, sending Bitcoin up nearly 8% and unleashing the biggest wave of short liquidations in records going back to 2021. More than $1 billion of Bitcoin short positions were liquidated in about an hour, according to data from CoinGlass, underscoring the speed of Wednesday's reversal that pushed the largest cryptocurrency to around $69,500. It's since gone even higher than that. That's the highest since early June and its biggest gain since March. Across crypto tokens, a record $2.7 billion in bearish bets were wiped out. The upswing came as President Trump met with crypto executives from firms including Coinbase, Payward, and Blockchain.com at the White House, adding to optimism around an administration that has sought to promote a more industry-friendly regulatory framework for digital assets. Falling borrowing costs added another tailwind. Let's see here. The move towards 70,000 triggered by short covering suggests buyers are regaining confidence, although the rally now faces a crucial test of whether it can sustain momentum and challenge the 75,000 region, said Axel Rudolph, chief technical analyst at investing and trading platform IG. The White House meeting took place after the Securities and Exchange Commission proposed this week to exempt certain digital asset offerings from securities registration statements as the regulator moves ahead with its crypto agenda after landmark legislation stalled in Congress. That is the Clarity Act, which is going a whole bunch of nowhere. The agency said the exemptions are intended to help companies at the startup and fundraising stages of their growth. Trump also said Wednesday he would consider regulators' recommendations on additional government Bitcoin acquisitions, though an existing executive order already directs the Treasury and the Commerce Department to develop budget-neutral strategies for acquiring more. And it looks like that's really what turbocharged it yesterday. That's what caused this second leg, which is what triggered the short squeeze, was President Trump went out and basically said the government's looking to buy more Bitcoin, even though there's, like they're pointing out, there's already been an executive order in place to do that. They're not going to go buy more Bitcoin. You can't do that without Congress unless it's budget neutral. And I don't know how you buy Bitcoin in a budget neutral way. The government could continue doing what they're doing. Every time they arrest somebody and seize their Bitcoin, just add it to the federal stockpile. Sure, they can do that. That's budget neutral. So that's what drove this big move in crypto yesterday. Will it last? I don't know. Is the bottom in for this cycle? I don't know. Typically, at least according to the calendar, Bitcoin would not find its bottom until later this fall. Typically, sometime around the end of October is when Bitcoin would historically have found its bottom prior to the next halving cycle. But yesterday's move was pretty convincing. So absent some big negative catalyst like somebody blowing up, it looks like the bottom may have been put in for this cycle. All right, here's the big one that's moving markets this morning, though. Walmart posts slowest quarter for U.S. sales growth in 6 years. Walmart's quarterly sales fell short of expectations, a rare miss that's likely to stoke concerns about the leading big box retailer decelerating alongside a slow-growing U.S. economy. Sales at U.S. stores open at least a year, excluding fuel, rose 2.6% in the second quarter. That's shy of the lowest analyst estimate compiled by Bloomberg. That rate of growth, hindered primarily by pricing pressure in its pharmacy business, is the slowest in more than 6 years. Walmart shares fell as much as 7.4% shortly after 7 a.m. Thursday in New York. All right, this chart here is showing Walmart's sales growth here in black as what they just reported at 2.6%. You'll notice Walmart has had fantastic comparable store growth over the last couple of years as they gain market share. And then, of course, all this was your COVID stimmies in 2021 and 22 cycling through the system. But the last time they had growth lower than this was the fourth quarter of 2020. And that was the Delta variant and the Omicron. That's like peak lockdown hysteria. Fourth quarter of 2020. Nobody was allowed to spend money, even if they wanted to back then. And then, of course, after that ended, you saw we went to like 10%, 9%, 9.2% in subsequent quarters after that. So you got to go to the peak of the COVID hysteria to find lower comps than this. Walmart's growth is slowing here. The results suggest it's getting more challenging for the world's largest retailer to maintain a faster growth rate as expectations from investors have risen. The earnings report also may foment anxiety about uneven economic signals and deteriorating consumer sentiment. Federal drug price negotiations affected Walmart's health and wellness business more than expected, CFO John David Rainey said in an interview. While transitory, the issue is expected to persist into the next year. By the way, that is our second transitory drop in this show. Maybe a signal there. Who knows? Excluding health and wellness, the company's U.S. comparable sales rose 3.4%. So that is interesting. If you take away what happened with the pharmacy, which was due to the federal government negotiating drug prices, if you take that away, Walmart's comps were 3.4%, which is precisely in line with what the consumer price index came in at. In other words, Walmart is just treading water here. Prices are rising, and so are their comps at the same rate. Walmart gained market share, including in grocery, as it continued to lower prices of goods. As consumers face more pressure, Walmart has been very intentional with where it's investing in price, Rainey said, pointing to beef as an example. Still, the retail environment remains competitive. Walmart's status as the country's biggest retailer makes it an economic barometer, attracting broader scrutiny from investors looking to gauge the health of the U.S. economy. And Walmart stock is not looking good ahead of the open this morning, now down 8%, $105.29 for Walmart stock, down from $114 yesterday. Year to date, the stock is now negative for the year, and over the last year, still positive by a couple of percent over the last 12 months. Now we got to talk about Scotty Boy over there at the Treasury Department. Bessent plan may be short-lived. Remedy for bond slump. A short-lived remedy. Well, I'm told there's no such thing as a temporary solution, so really it's just a Band-Aid then. The global bond rally triggered by U.S. Treasury Secretary Scott Bessent's plan to increase buybacks of longer-dated debt may prove short-lived, with analysts citing persistent fiscal woes and sticky inflation globally. Franklin Templeton, Barrenjoey Markets, and Nomura Holdings are among those warning the positive spillover effect to other bond markets would likely be limited, given many governments around the world are still grappling with growing debt piles and budget deficits. The gains triggered by Bessent's move were already losing steam on Thursday, with long-dated U.S. yields back on the rise. Rates in the U.K. and some European nations were also edging higher or hovering around multi-year peaks reached in recent days. It's going to be like a circuit breaker for this long-end sell-off globally, said Andrew Lilly, chief rate strategist at Barrenjoey Markets in Sydney, but it's not enough on its own to stop the yield rise. On Wednesday, the Treasury said it would at least double the size of its bond buybacks in a rare intervention that also betrays Washington's growing unease with elevated borrowing costs. Analysts warn that Bessent's plan risks being a short-term fix due to investors' entrenched concerns about outsized fiscal deficits, oil-induced inflation, and broader supply pressures from the AI industry's borrowing binge. In other words, what the Treasury did yesterday didn't fix anything. They just papered it over, and so don't expect that to hold. But some investors are unconvinced. For one, Franklin Templeton maintains underweight on long maturity bonds, arguing that Bessent's move is unlikely to spark a more sustained rally. The U.S. 30-year was already edging higher again on Thursday, up 2 basis points to 5.22. There's a synchronicity of forces arguing for higher yields, steeper yield curves with the largest developed markets all facing fiscal pressures and stubborn inflation, said Andrew Kenobi, a director of fixed income at Franklin Templeton. Help me, Andrew Kenobi. You're my only hope. I can see the longer end finding too much of a bid as long as those forces are prevailing. Now, that being said, you're talking about fighting the U.S. Treasury. And they kind of get into that at the end in this Bloomberg article here. That said, while governments and central banks do have powerful tools to influence market, the deep-rooted concerns about long-term fiscal risks facing developed nations means investors are likely to keep testing those authorities. It's always dangerous to try to fight people who can make up the rules, said Andrew Ticehurst, a senior rate strategist at Nomura in Sydney. But the weak underlying fundamentals are substantial and increasingly apparent. So here, it's inflation. It's fiscal deficits. It's maybe this $40 trillion pile of debt. Holy shit. Maybe that's why interest rates keep rising. Maybe people are demanding a higher interest rate for a loan because they take a look at this number and they say, there's no chance in hell they can ever pay this back. Maybe I'll be able to sell my highly liquid U.S. Treasury. But let's be honest here, guys. The government is hopelessly in debt. They are going to default one day, whether it's a traditional default where they just don't pay it back, or by just debasing the currency into oblivion to the point where what you get paid back isn't worth anything. One of these two things is going to happen, right? Default is now inevitable. It's 40 trillion. You're just never going to unwind this. So people want higher interest rates. And so you can play these games with the supplementary leverage ratio, or you can increase buybacks. You can do all these things that will provide some temporary relief. But if you don't fix what's killing you, you're still going to die. You might feel better in the short term, and this is what's killing the Treasury market. Meanwhile, U.S. is set to cut tariffs on Canada metals, autos, in trade deal. Let's not spend too much time on this, shall we? Because we've heard this song and dance before. But there is some progress on the trade front this morning. Tentative trade deal between U.S. and Canada would lower tariffs on certain Canadian exports of steel and aluminum to 25% and cut duties on Canadian auto exports to 15%, according to people familiar with the matter. The details have yet to be finalized and are not expected to apply across the board for steel and aluminum. Different rates could apply to some derivative products that include those metals. That's according to people familiar with the matter. Tariffs on the non-U.S. content in autos exported from Canada would be reduced to 15% from 25%. All right, so there's still tariffs. The tariffs are going to be lower, and the details have not yet been finalized. All right, so let's not celebrate yet, but we're looking at lower tariffs here. We have a deal. All right, great. Right? Isn't that great? We've had a lot of deals lately. So many deals, I don't know where I'm going to put them all. Meanwhile, China sentences Evergrande's Hui to life for heinous crime. And again, I mean, I'm not one to throw compliments toward the Chinese, like ever, but we're going to do it here because the Chinese are doing this one right. China Evergrande Group's founder, Hui Ka-yan, has been sentenced to life in prison, bringing an end to one of the most dramatic rise and fall stories in China's corporate history. The disgraced property tycoon, once Asia's second richest man, had turned Evergrande into a poster child of corporate excess during China's long real estate boom. But after his empire came crashing down following a 2021 default, he was caught in a dragnet of official investigations that ultimately caused his downfall. Hui, who appeared visibly aged in court with graying hair, was sentenced alongside 56 others involved in Evergrande, including his two sons, which I'm not even going to pronounce them. We've got, let's try it, Zhu Zhizhuan and Zhu Tanghe. The two Zhu, they're both going to jail. His assets will be confiscated, and his companies were fined a combined 15.8 billion yuan. That's $2.4 billion. I can't help but notice here, guys, 56 others were prosecuted for their involvement in Evergrande, not just the founder. 56 other people. We never get that here in the States. How many people went to jail at Enron? Like 3, 4? How many people went to jail at FTX? Sam Bankman-Fried? Caroline Ellison got a light sentence for testifying against him, and that guy Sam, who knows whatever happened to him, he disappeared. We never prosecute 56 people. We get token prosecutions. And then the penalties are usually a slap on the wrist. Sam Bankman-Fried's already on Twitter asking for a freaking pardon. The move draws a curtain on what for years was one of China's great success stories. Hui had binged on debt during Evergrande's expansion, turning it into the world's most indebted developer as he transformed the property giant into a sprawling conglomerate. But Chinese authorities concluded that his rise was built on deception. They said Hui had perpetrated a massive financial fraud that included inflating assets and concealing liabilities. Well, gee, isn't that exactly what all the big tech companies are doing in America right now? Aren't they all inflating assets with round-tripping schemes while concealing their liabilities in special purpose vehicles off balance sheet and selling that shit to our pensions? Interesting. You get life in prison for that in China. You get multi-trillion-dollar valuations for that shit here in the States. In April, Hui had pleaded guilty in Chinese court to charges including illegally taking public deposits and fundraising fraud. The amount involved in the crime is exceptionally large. The circumstances are particularly heinous. Exceptionally heavy economic losses have been caused, and the harm to society is extremely grave, a report from state media outlet Xinhua wrote, adding that Evergrande and Hui must be severely punished in accordance with the law. Evergrande and Hui were also found guilty of fraudulently issuing securities, violating information disclosure rules, as well as bribery. Meanwhile, the founder was accused of embezzling company assets through dividend mechanisms. Again, guys, I'm not one to heap the praises on the Chinese Communist Party, but Hui Kaiyan is getting life in prison, billions of dollars seized, 56 other people getting prosecuted, including family members who participated in the scheme. In this case, they're doing it better than we do, a hell of a lot better than we do. Meanwhile, Taiwan floats record defense budgets, sending message to the U.S. and China. Plan to lift spending by 18% above the symbolic 1 trillion new Taiwan dollar threshold. Now, we talked yesterday, I think it was, or maybe it was 2 days ago, but we talked this week about how Taiwan was giving stimmies to everybody in the country because of the big boom in their budget because of AI and the 11% GDP growth that Taiwan has seen this year. Well, it looks like that money is also going towards things that go boom. Taiwan's government has proposed its highest level of military spending in ever at over $35 billion US and a $123 billion budget for 2027 unveiled on Thursday. The plan, the government said the budget includes 1.1225 trillion new Taiwan dollars. That's 35.2 billion US. A sum that includes funds for the Coast Guards, pensions, and special budgets for buying arms from the U.S. The proposed defense budget is the first to exceed the symbolic 1 trillion new Taiwan dollar threshold with an 18% increase from last year. It would put Taiwan's defense spending at around 3.93% of 2025 gross domestic product, up from this year's 3.23%, according to the government. All right, so there's some key numbers in there. 3 to 4% of GDP spending on defense. That is in line with what the U.S. spends on defense. So at the very least, as we all get ready to fight World War III over this island, at least the people who live on that island are paying their share of the defense. So I guess that's encouraging. I'm looking for the good side here, guys. I'm trying to be optimistic about World War III. I don't know how one does that. I'm open to suggestions. But also that 3.93% number, that's a little bit deceptive because that is 2027 spending being measured against 2025 GDP. And remember, Taiwan has seen 11% GDP growth just this year because of the AI bubble, because all of our retirement plans are being slowly funneled to Taiwan Semiconductor to keep NVIDIA's revenues inflated. And so the actual percent of GDP spending on defense won't be quite that high. It'll probably be closer to this 3.25% number that they're saying here. But they are increasing their defense spending 18% faster than GDP is growing at 11%. And so Taiwan is taking their own defense seriously. And you can see this in this chart here. Taiwan's defense spending, big increase for 2026 this year, and another big increase projected for 2027. Things that go boom, doing really well these days. Meanwhile, we've got Russia and Ukraine's Black Sea grain exports grind to a virtual halt. This is important, guys, because wheat prices went vertical in 2022, And then Russia and Ukraine and several other countries got together and they created this Black Sea grain initiative. It was just basically a gentleman's agreement between warring parties that they weren't going to mess with the food supply in their fight. And that agreement, though still in place, has been completely discarded. Attacks on shipping have shut down more than 97% of Russia and Ukraine's grain export capacity in the Azov and Black Sea basin, cutting off a major source of low-cost supplies and helping to drive up global prices. The two main grain exporters have intensified attacks on ports and shipping over the past month, leaving importers in the Middle East, Africa, and Asia facing the prospect of sourcing grain from higher-cost suppliers such as Australia and the United States. Russia and Ukraine together exported an average of 7.2 million metric tons of grain a month from terminals in the Azov and Black Sea region last year, according to Reuters calculations. There are currently no shipments from Ukraine's Black Sea terminals. In Russia, the only grain terminal not officially shut is a small terminal in, I don't know how to pronounce this, Tuapse? In this small town with a capacity of 160,000 tons per month, officials and trade sources say. The shutdowns represent a loss of more than 97% of grain export capacity compared with last season. Yikes. Now, Ukraine is exporting grain through rail links with Eastern Europe and the Danube River ports, at least while they can still navigate the Danube River. We've talked about how the water levels in that river is way down, that they're shutting down nuclear plants and they're having to ship smaller cargoes. So even the river shipping is being made very difficult. That's each accounting for about 45% of shipments, with the remaining 10% transported by road. Saying here, we expect that we will be able to reach 50% of our export potential if the ports remain blocked. That's according to this guy, Vysotsky. They're basically saying, look, it's more expensive to move things by rail and by road. We'll do that if we have to. It's not that we don't have the grain. It's we can't get it on the boats and get it out. So we have to use more expensive, longer-term methods in order to ship it. And so it's pushing grain prices higher. Look at the chart of wheat prices here. These are monthly candles in the wheat prices. We're the highest that we've been since January of 2024 right now. And the interesting thing is they're rising, but we are still nowhere near the obscenely high levels that we saw in the beginning of 2022, shortly after the invasion of Ukraine, when wheat prices just went berserk. Now, it was the agreement, the Black Sea Grain Initiative agreement, that took us down from those levels. That was the first rumblings of the deal were in February of 22. They actually agreed to it in April, and we saw grain prices came down sharply lower shortly after that. Now that deal has been thrown out. Grain prices are only now just starting to rise. And the reason why this is important is because of what is brewing in the Pacific Ocean right now. It's not a thing yet, but it probably will be. And that's this guy, El Nino. Maybe I'm showing my age a little bit here, but I still laugh about this. Yes, El Nino. We are headed towards one of the most powerful El Ninos on record in the Pacific, just based on the current trend that is emerging. And when you get a strong El Nino, basically global precipitation patterns shift. You get wetter areas where they get way more rainfall than typical, and then you get other areas get dry and you get much less rainfall than typical. And unfortunately, the places where you get less rainfall tends to be where we grow a lot of food. And the last time we had a super El Nino, or the biggest El Nino on record, was 1876, 1877. And about 50 million people starved to death over that super El Nino and the crop failures that happened around the world. Now, 50 million people are not going to starve to death next year. It's not going to happen. We have a global commodities market that moves stuff around very efficiently. Colonialism contributed dramatically to starvation in places like India and China. And so that exasperated the super El Nino back in the 1870s. We're not going to get anything like that, but we probably will see significantly lower crop yields next year. And so anything that's going on with grain this year because of what's happening in the Black Sea will be amplified by what I suspect is coming next year. It's still early. All right, this El Nino has been strengthening pretty much all year. Typically, it doesn't hit its peak until December. The trend could still reverse, and maybe it won't be that bad. But right now, it's shaping up to be a big one. All right, last one of the day. Jefferies targets 1 billion euros for private credit secondaries fund. And this is awesome because Jefferies has got such a a great track record recently. Let's talk about what's going on in private credit this morning. Jefferies Credit Partners is seeking to raise around 1 billion euros, $1.16 billion, from investors who trade private credit in the secondary market. The fund will acquire loans from its existing portfolio and provide fresh capital for new lending, according to people familiar with the matter. Private credit managers have increasingly used secondary transactions to generate cash from existing loan portfolios and raise capital for further lending. In a similar transaction, Goldman Sachs sold an existing loan portfolio to a new vehicle backed by secondary investor Pantheon. As a continuation vehicle or a staple deal, the Jefferies Credit Partners Fund will comprise about 500 million euros of equity and 500 million euros of leverage, the people said, asking not to be identified because the information is private. The Evergrande Fund will be able to recycle capital indefinitely. It will hold loans previously originated by Jefferies Credit Partners. That's interesting. Put a pin in that. Ares is also preparing to sell a 3 billion euro of bundled stakes in a flagship European direct lending funds in what could be one of the largest credit secondary deals ever. And again, the reason why they're doing all of these secondaries and continuation vehicles is because they can't sell this crap because it's not worth what they market at. All right, these are not publicly traded instruments. They're very difficult to properly value. And so these guys get away with overly inflating their values, knowing they could never possibly sell it for that. And when investors get itchy trigger fingers and want their money back, they just create a new fund and they move the investments into that new fund, use the money raised there to pay back the old fund. Yes, that is very much like a Ponzi scheme. But the thing is here, this Evergrande Fund will be recycling capital and it will hold loans previously originated by Jefferies Credit Partners. And that's awesome because Jefferies and their risk management folks have got such a phenomenal track record recently. Let's just talk about some of the highlights that Jefferies has been directly involved in just the last 2 years. We've got Tricolor. Remember Tricolor Auto? That one was fun. First Brands, multi-billion-dollar blow-up. Jefferies lost a bunch of money there. Market Financial Solutions, the Bangladeshi mortgage fraud that was borrowing money from UK banks and US private credit insurers. Yep, Jefferies lost a bunch of money with Market Financial Solutions. Water Station Management. That company was an abject fraud. Jefferies took a big hit there. More recently, Sapphire Min Metals and Radiant World, two iron ore trading companies that were doing receivables fraud. Jefferies lost money with them too. Jefferies has had one hell of a run. And again, guys, if you're looking for a change in career, check out the job offerings at Jefferies because I think there's probably going to be some openings in their risk department in the months to come. And now they want to raise €1 billion from new investors and use that money to pay off their old investors. Good freaking luck. Hey, I just want to say, everybody, thank you so much for having your coffee with the Melonheads this morning. I appreciate that very much. Don't forget the like button, the subscribe button, all that good stuff. Really helps the channel out. I'll see you guys tomorrow. Thank you also to my magnanimous Melonheads on Patreon, YouTube members, and Buy Me a Coffee for supporting the channel. You guys are awesome. And there's links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time. Live small and dream big.